Welcome everyone. Thank you for joining us. Just to give everyone a few seconds to join in. Thank you for joining our webinar on protection at every stage of life. It is a very important topic to make sure that you and your family are protected. I would now like to introduce our team. My name is Bianca Carroll. I'm a Client Service Coordinator at Smart Business Solutions. And after working with Shannon, I realised how much I enjoy financial planning, so I'm now studying financial planning as well. I'd also like to introduce today's presenter. Many of you have probably already met Shannon Smith, founder and managing director of Smart Business Solutions and a qualified financial advisor of Smart Business Solutions Financial Planning. Shannon really enjoys advising clients, not only in their business side, but also on their personal side and bringing the two together. With all the changes in the financial industry, there are 22,000 licensed financial advisors in Australia, and so far to date, only 700 of these, Shannon included, have passed the exams and educational requirements. I'm sure that we've been through COVID. After being through COVID, many of you are familiar with Zoom and online meetings. So I'll just briefly let you know that if you do have any questions, just to submit these in the Q&A box, and we'll go through the questions at the end of the webinar. Next is the important information that I need to tell you. This presentation contains general advice. It does not take account of your individual objectives, financial situation, or needs. You need to consider talking to a financial advisor before making a financial decision. This is not a forum to provide personal recommendations or information specific to your individual circumstances, and it is important that you talk to a financial advisor before making any investment decision based on this presentation. Because the information may not be suitable to your individual objectives, financial situation, or needs. The information in this presentation is based on current superannuation, tax and social security laws and rulings as at the 10th of February 2021, and these may change in the future. I would now like to pass you over to Shannon.
So what I wanted to go through today, and it's great to see so many people joining. I know insurance is probably not the #1 topic that everyone wants to talk about, but there's really a lot of aspects that I really like to talk with my clients about to make sure they fully understand what their insurance is, that they have the cover that they have in place, and to really make sure that when they actually need that insurance, they're appropriately covered, but also most importantly, they're also paying the right amount, that we're not overpaying, under-insuring, over-insuring. So I want to go through why insurance is important, the types of personal insurances, how you might look at insurance to cover over different life stages, and then how much insurance cover do you actually need? And then the other big one is what are stepped and level premiums. And that's really, really important because I think a lot of insurance brokers don't really go through that in detail with clients, so they really don't understand what it is that they're buying. A bit of a summary on, is insurance tax deductible? Of course, that's a bonus. I'll touch briefly on business insurance. I am only going to do that at a high level. I will do a separate webinar on business insurance. And then just how advisors can help and some of our upcoming events. So we've kind of, with some of the surveys we've done with clients, asked what you'd actually like to hear from us on. So we're going to be running some more of those events, and do give us feedback if these times work for you best. We're kind of going back on feedback that people said actually at night when I can, have a glass of wine or a coffee is a good time. So I'll get started. Feel free to put any questions through. So when we're looking at insurance, and what this slide deck, just by the way, we will be emailing this out. There is a lot of detail on this, so you can always go back to those details as well. But why is insurance important? Because actually, as we all know, insurance is quite expensive. It's expensive whether it be with our car insurance and all of those different areas, but we always do go and get that car insurance. But when it comes to your personal situation, insurance can be expensive, but what you're trying to look at from an insurance perspective is you've basically created your lifestyle, you've got your business, your income, and you've got your family, and then also your health. Now, what you're wanting from insurance and why it's important is insurance, we actually hope, in a sense, even though we're paying these premiums, we actually hope to never actually need it. That's probably a good thing because it means nothing has happened. But what we want insurance to be there for is if something happens, we in theory shouldn't be in a better position because of the insurance. We should be in the same position. So if you can't work, or if your partner passes away, you've got the insurance to kind of fill that financial gap, so that you are not in a situation where potentially you're forced to sell the house or other things like that. So really, whilst it is an extra cost, it's about balancing the cost with your comfort level as to what you can, in a sense, afford to cover for insurance, and also how your family could continue if there was to be an event, an insurance type of an event that would happen. When we look at the chances of what are the chances in preparing the worst, I don't like to be doom and gloom on it, but they actually do say 1 in 2 people get diagnosed with cancer by age 85, 1.2 million have a heart disease each year, and 1 in 5 are living with a disability. So, while you're young and healthy, and I'm always encouraging, especially those that are in their 20s, go get a great insurance policy at that time, because it's so cost effective. When I talk about step versus level, you'll understand what I mean about that. But sometimes these things do happen, unfortunately. So just touching on some of the, the I guess we call it the underinsurance challenge that we see frequently. A lot of people don't realize, but the average amount of life insurance required for a young couple aged 30 with kids is $700,000. 70% of all life insurance is held by Australians through super. Now, one fact that I think is interesting to say, and maybe go and have a look at your own insurance policy. Many people have what we call retail superannuation fund. So it's, you started work and you ended up with your retail super fund, and they gave you insurance. Now, you probably didn't even look at that insurance. Now, they actually say 70% of Australians only have $200,000 in insurance, life insurance, because that's the default one that came with their superannuation fund. So it's having a look at that insurance that you've got. They're also group policies, which means they tend to erode as you get older. The balance goes down. So it's not enough really just to have insurance. It's actually making sure it covers what you need it to cover if something was to happen. So just to go through the main types of insurances that there are, we've got 4 main types of insurance. So life insurance pays a lump sum to your beneficiaries if you pass away or you become terminally ill. TPD pays a lump sum if you become permanently unable to work due to a serious illness or injury. Now, trauma, and both of those two, generally we do see those being held inside of inside of superannuation. So you may not even know that you've got them because they're inside of your super. So have a look at your superannuation. Trauma insurance, you know that you've got trauma insurance because it's not tax deductible and you have to pay for it outside of super. It cannot be held within super. Trauma insurance pays a lump sum benefit if you're diagnosed with a specific major medical condition. Then there's income protection. Now, this is paid as income. So income protection basically provides a monthly benefit of up to 75% of your salary if you're unable to work due to illness or injury. So they're the 4 main types of what we call personal insurances that you may have. So when we look at your different stages of life, and this is why it's kind of appropriate to keep looking at your insurances and maybe revisiting those. I don't know whether it's every year. We often say to clients, we might look at it each year, but we may not do any major changes for, 2-3 years. It depends on what the client's doing. But, when you're starting out, focusing on a career, enjoying life, you probably need income protection and potentially TPD. Someone in their 20s, you might need, you might get a great life insurance policy, but income protection if you've got some debts when you're, maybe you bought a property at that time, or if you get permanently disabled. When you start raising a family, you all of a sudden your priorities start to go to supporting a family and buying a home. And so the insurance needs tend to go around to all 4 insurances. Your income protection, what happens to your household? You've got kids, you've got, school fees, you've got mortgage, all of these expenses. What happens to your household if you can no longer work? How do you get the income to actually pay your mortgage? what happens if one was to pass away or permanently disabled, and then also, and we've seen this with a few of our clients as well, especially around the trauma where one of the parties gets very sick. So when you're raising a family, you're going to be, in a sense, needing, what can we get the insurance company to cover that will ensure that our life stays, in a sense, intact during this trying time. Once the kids leave home, potentially your priorities might be paying off your mortgage. You may have already paid it off. You may be saving for your retirement. So your insurance needs may be the same types of insurances, but potentially a different level of cover. Now, if I look at that, for example, if you paid off your home and you had your house, then that would affect your insurance needs, because you don't have a mortgage that would need to be paid off if you weren't able to work for a certain period of time. Then when we come to retirement, now it depends on where you're at financially. A lot of my clients that have actually gone into retirement, if they've paid off their home, they've got passive income, and they're kind of self-funded retirees, most of them actually don't have insurance in that case. Some of them, if they've still got a mortgage, they'll still have insurance. So it really comes down to your own specific circumstances, but it will change over time as you go through life. So I'm going to go through some of the big questions to actually help you actually look at, well, how much insurance do I actually need? And what is it that I'm trying to get the insurance company to cover? So you'll have to calculate how much money would your family need in order to maintain your current standard of living if you are no longer around. So if we're looking from a life insurance, so kind of making a checklist of what do you need? Liabilities to clear, future expenditure required, future education, medical costs or recovery, funeral costs, and then what do you have? What assets do you have that you could dispose of? And what continuing income do you have, and what would be, in a sense, that present value? So that continuing income, that may be investment property income, but if you did have, for example, income protection, that would be an income that would be coming in. So I'll go in each of those areas in more detail, because that's really what we're trying to look at, is what are we going to ask the insurance company to cover on our behalf? And then what is it that you're potentially going to look at self-insuring, so that you're actually saying that there's a gap and you're prepared to take that cover yourself and self-insure. So if I look at the liabilities to clear, so if something was to happen, what do you want with the situation on the mortgage? So it's not just your current home, could also be your investment properties or holiday homes. But if something was to happen, what would you like the insurance company to pay for? Obviously, if you got them to cover all of your mortgage, if you had an investment property, your home, holiday house, you know, the more cover you have, the more costly it's going to be. So it really comes down to, well, what is it that you would like to have covered? Some people say to me, well, look, I don't need the mortgage on my investment property, because if something happened to one of us, we'd sell the investment property, and so I don't need that covered. Any other outstanding loans that you have, personal loans, business loans, any existing credit products, so credit card, charge accounts. So you're really looking at, well, what liabilities do you want, if something was to happen, the insurance company to clear for you? And then the big one, especially if you've got children, what are the future education expenditure requirements? So what are your annual living costs? Now, if something was to happen to one of you, would the other one be able to work and have that same level of income as a family to be able to sustain all the expenses that you have? Or would you like the insurance company to cover some of that? Now, probably we all would like the insurance company to cover some of that. So when we are working with clients and going through this, is we kind of say, well, look, what would you like? And I call it perfect world, the insurance company to cover. So we've got annual living costs, and we usually do that from, say, today up until age 65, on the assumption that at that stage the age pension would kick in. What are the education costs for your children? Could be public, could be private school. I mean, even public schools, there's still quite an outlay that you need to do. And we would factor all of that in for the next number of years and bring it back to a present value today that might need to. Other planned expenditure, whether it be holidays, renovations, any other investments you have. Is there other expenses? And then also homemaker duties. And this is one thing that I do find a lot of people overlook. If you do have one of the partners actually out at home looking after the children, homemaker duties, actually, if something happened to them, and a lot of people think, oh no, I only need to cover the income producing person of the family. But if something happened to them, well, then how would, what would happen with the kids? What support would you need there? Maybe would family kick in and help on that? Would you need a cleaner coming in? How would you do that? So it's actually looking at those homemaker duties that you might need to be covered. So what kind of future expenditure might you need? What continuing income do you have that may actually reduce the amount of cover? So if an employee has significant annual leave and long service leave, we can take that balance off the total requirements because that would be paid out. If they have income protection, so this is only for TPD or a trauma claim, if you had income protection. So for example, we had one of our clients was unfortunately just after the birth of their third child, about 2 months after. She was diagnosed with breast cancer, and fortunately, it was if you're going to call it a better situation or a type of breast cancer, they were able to remove it all. Now we're talking 2.5 years on now, that she did have trauma insurance and she did also have income protection. She worked in her husband's business. So we were able to get a lump sum payout of $340,000 for them. For the trauma claim, and then she had ongoing income protection, and the relief that gave them for the family and being able to do that. And when we were looking at the level of insurance cover required, we had assumed, because we knew that she had the income protection, so we took that into account as to how much would we need from our lump sum perspective. Any investment income, if you happen to have an investment property, and then also super. Now the super applies if the person passes away. So for life insurance purposes, then we would have the superannuation payment. So that could reduce the amount that is income that's coming into the family. We reduce the amount that we'd need the insurance company to cover. If you are TPD, we may under hardship be able to get some super, but it's generally only for under the life. So we're really trying to look at, well, what continuing income do you have that we can rely on going forward? And then we look at disposable assets. Do you have any assets that you may dispose of, so that we can have a look at what would be the what is your required amount of insurance cover? So any current savings, the family home. I know when we're chatting to some clients, they say, well, if something happened, we'd probably sell it or downsize it, or we might want to keep it, and hence we'd cover the mortgage. Investment property, I know I have, a lot of clients say, well, look, if something happened, we just sell off the investment properties. So we kind of look at what are those disposable assets that may be able to be sold. And that really comes then to coming up with what is that you're wanting the insurance company to cover. Here are our assets. Here's the ongoing income that we expect to get. Here's the ongoing expenses that we're going to have to pay to keep our family going. And here's the disposable assets, to come up with a figure. And when I talked earlier about family, with age 30 with young kids needing approximately 700,000 in cover, and that's going to depend, I guess, on the family situation, the size of the mortgage. When I see mortgages these days, I'm not sure 700 would cover, and also how long someone would like that continuing income to cover. So I know with some of my clients, they say, the breadwinner might say, well, if something was to happen to me, I want to make sure that I've got food on the table till, age 65, the pension. I want to make sure that my partner doesn't have to go to work because the kids are going to need them even more. So I want that all covered in my in my insurance. Now, what we do when we're working with clients on that is we come up with, they come up with their wish list, because we're all going to start with the wish list. We will often go in and have a look at some potential insurance options for them and what the premium might be. And then we start balancing that out, because I might come to a client and say, well, actually the premium on that is X. And they might say, well, we don't really want to pay that much in insurance. What can we get for a lower amount? What kind of cover can we get? Because insurance is twofold. You need to have the cover, but you also need to afford it. I mean, you don't want people to be paying so much on insurance premiums that they're not even being able to live the life they want to live today. So it's a real balancing act. And I think some people really forget that, that part as well. One thing I did want to look at is the stepped versus level premiums. And this is really, really important. And the reason I say that is there's two types of premium structures, and step premiums start lower than a level premium, but they increase as you age. So they start quite low and then they go up by steps. And so the reason I stress this is I think that a lot of insurance brokers don't always explain this to clients. So often they might say, hey, I can get you a better deal on your insurance. I've saved you $2,000. But the client hasn't understood the difference between stepped and level. They may have been on level before and now they've been converted to stepped, which yes, may start at a lower premium, but it will actually increase as you go up by chunks. What that means is in the earlier years, it's fine, it's very affordable, but as you become older, it actually chunks up. So step looks at it and says, oh, you're 30 today, here's what your premium is. When you're 31, it says, oh, you're 31 today, here's what I'd pay, here's the premium of a 31-year-old, a premium of a 40-year-old, and so it goes up. Whereas when we're looking at the alternative of level premiums, what level premiums do is they actually start, they'll cost more to start off with, but they'll start today and they are kind of level. They go up by CPI index. So you've literally locked in, and if you got it at say age 30 or age 40, you've literally locked in a premium at age say 40, you've locked it in for it to continue throughout and just get the CPI increase. So you will pay more for level premiums, but there will be a tipping point. So how do you know which one is right for you? Generally, level premiums don't make it worth it until it's about the 6 or 7 year mark, and then you're going to have a tipping point. It could be even longer. We always calculate both of them so that we can really advise our clients whether it's best to have stepped or level. So it really comes down to how long are you going to have the cover? Do you want to keep the same level of cover? Do you have children? How long is that period? How long are they going to be dependent on you? And if you think you have the right cover now, and how long you're going to actually keep it, and you're going to have that cover for a long time, then level premium is probably the best one. However, you know, as you get older, maybe you need to increase or decrease it. So we always look, it comes down to, I guess, the situation of where you're at and how long we're intending to have that. So I've just kind of summarized the difference between stepped and level, and it's really important for you to understand those and take a look at your policy and see if it's stepped, see if it's level. If you're in what we call a group policy, which is one within the super fund, like the $200,000 one that you get as a default, that'll usually be step premium. So every year it gets more expensive. Now it's in your super fund, so you may not have noticed that it's getting more and more expensive. I know I looked at a client recently and they had about $1 million of insurance cover, they said, about 10 years ago. And it was in a group policy. And now today they've got about $400,000 cover because it went down and down and down over the years because it was just part of one of these group policies. The problem was the premium has actually been going up. So they not only have gone from $1 million down to $450,000 of cover, their premium has actually increased from 10 years ago. And so you have a situation where you're kind of paying more and getting less. Then I just wanted to go through a bit about whether insurance is tax deductible or not. Obviously, that shouldn't dictate whether you buy the insurance or not. But I have seen many, I'd have to say it's ridiculous situations where I've seen people holding life insurance and TPD outside of super. And look, it depends on the facts and circumstances of them. But if you own it personally, the life and TPD, it's not deductible. So you're paying for it with after-tax dollars. Whereas if you have it held by your super fund, now you can actually still make your retail super fund pay for your policy for you if you want to, so that you have a great insurance and it's being paid for that. But it's deductible to the super fund. Trauma insurance, as I said, it's not deductible anywhere. So you know you're paying it. As well. And then income protection is deductible. Now, sometimes I've seen insurance brokers say to clients that they should have income protection and, hey, look, we won't interrupt with your personal cash flow, so I'm going to put it in your super fund. Now that yes, it's deductible in your super fund, but the problem is if you've got income protection in your super fund and something happens and you need your money, now you actually go to the insurer and ask for your money and they say you've satisfied the claim and that's no problem, we're going to pay you your income protection. And then all of a sudden you realize that income protection money is going into your super fund and you're not at retirement age. So you actually cannot access it unless you've got absolutely severe hardship. Maybe the ATO will review your situation. You'll have to apply for that and see if they'll give that to you under hardship. But generally speaking, you'll get income protection. Your super fund will make a lot of money on it, ready for when you retire, but that doesn't help you today. So income protection, generally, owned personally, it's tax deductible anyway at a higher tax bracket, but that's something to really have a look, because we do see that coming up quite a bit. I just wanted to touch just briefly, I will do a different session on business insurance, but for any business owners, I think there's many that you don't realize that you can actually balance your personal insurances with what you've got in your business as well. You do have some unique risks within a business, especially if you've got key people in your business and if there's a drop in revenue as a result of that. So the four main insurance options, and I will go through this in a different session, is buy-sell insurance. So that's where mainly if you've got, usually two parties, and if something happens to one of the parties, the insurance will step in and buy out that person's estate and pay them for that. And then the shares will pass to the other person, so that you don't have an issue where one party has to find funds to buy out the other party when someone passes away or is severely injured. You have key person capital insurance. So we're just saying if something happens to one of our key people that is going to drop in a sense and cause it, similar to the key person on revenue insurance, it's going to drop, for example, in revenue, it's going to drop our revenue. We can actually get that guaranteed. The capital is actually, if we're going to have one of these situations, we may have insurance to pay off any business loans that we potentially have as well. Then you can also insure business expenses as well, so that if something was to happen, your expenses are covered. So some of the areas that as an advisor where we can help, the big things are looking around assessing what you need and what's maybe are some of your risks. Have a look at your budget on what you can afford. We're always going back and forth with clients before making a recommendation, because it's no point in just having an excellent cover that's costing you, nearly an arm and a leg. We try and balance that out, and also adapting it over time, because as you maybe you pay off your home, we've got to reduce your insurance and keep that going as well. So that comes into looking at how much insurance you're going to need. We like to build a tailored insurance strategy. What I say from that is making sure, and I guess that's probably the reason I started insurance, because I started dealing with different insurance brokers, and they kind of were trying to sell lots and lots of different products to my clients without seeing how these products overlap. For example, if I have income protection, that's going to reduce the amount that I'll need on trauma and the interlinking between it. If you've got business insurance, personal insurance in the business, you won't need as much outside as well. So I like to kind of do an overall strategy and look at it more holistically. We go through and help you understand the premiums. What's the excess and what are exclusions? So if you are, if you've had some health conditions, there may be some exclusions, and what are those and what can we do about it? And making sure you clearly understand what's included and what isn't. Review your cover as things change and make updates as well. And if there is a claim, as example, we've had with some clients, assisting through the claims process. And if we've gone through, when you're going through the insurance companies that are not just, in a sense, the group policies, you're actually already doing the underwriting up front. So you're already having the insurance company get you do all the medicals and all of those checks. So when it comes to claims, our claims have been settled. All the ones that we've basically put through so far have all been settled in less than 48 hours, because we've already done all the hard work up front. Now it's a matter of, here's the medical reports, here's what's happened, and we've had the claims settled really quickly, which has been a great outcome, especially in a stressful time. So some of the next steps is really assessing your needs. So go through, what is it that we need, build the plan on it, then implementing the plan on getting that cover, and do make sure you review it, because as you pay down, say, your mortgage, as the kids go through school and all of a sudden you don't have as much debts, you can have a look at that, and then hopefully we never need to have the claims situation. Now, we've got a few upcoming webinars that we're planning throughout the rest of the year. If there's any topics you'd like to hear from us, do let us know. Looking at planning for your retirement, we've just done the SMSF, the right choice for you, a bit more on business insurances. Want to go through investment fundamentals 101, super made simple, transition to retirement, saving budgets and managing debt for millennials, some business succession, redundancies, what are the next steps, and estate planning. And if you miss one, it's okay, because we will include it onto the website. And as Bianca introduced earlier, myself and Bianca are the financial planning team in the office. So if anyone's got any questions at any time, whether it be today or at any time, feel free to reach out. Have there been any questions there, Bianca? Have you got?
Just a couple. So if someone has stepped premiums, can they change to level premiums?
So in your policy, you can't actually just change that in your policy. So you actually can't just say, oh, look, can I flip to level? It would be actually coming up with a new policy. So we would be actually looking at a new policy. You can change it. It will mean your insurance cost for that year, in a sense, will go up when we're comparing it. But what we would be looking at is making sure that it's going to be in your best interest. So if you were 40, and you're expecting that you would hold life insurance till, say, age 65, which is quite a common situation, then most likely it's going to be in your best interest to be on level. We've seen many clients that have said, oh, we changed our insurance about 5 years ago and the broker saved us a heap of money. And then we have a look at their policy and we're like, oh, that's because they put you on stepped instead of level. And now we're going to have them with, a higher situation. So you can't actually just change it. It's not like you want to change your electricity bill from paying monthly to paying quarterly, unfortunately.
Another one, if a client sees a chiropractor on a regular basis, can they get insurance?
Yeah, so they definitely can get insurance. When you're going through the underwriting, what's important is making sure you tell the insurer everything, because you don't want to have a situation where a surprise comes up. Get all the medicals. And it's not an issue in going to a chiropractor. What will happen is usually the underwriter will say, well, why do you go to the chiropractor? Now, we've had clients, one who'd been going for like 20 years just because her parents kind of had her going every month for an adjustment, and she's just kept doing it for 20 years. Now, if you've got that situation, it's always been a proactive health situation. If you've gone to them to start off with because of a sore back and you've been going for now a few years, they'll just ask to do some extra tests and see what the situation is. So it's not an issue from that perspective. Potentially, if they see that there's an issue with your back, they may exclude your back. So if something happens to your back, you don't get the insurance, or they may accept that they will cover it, but they will have what they call a loading, which means they expect there's a more likelihood that you may have an issue, and therefore they'll make your premiums higher. So they may put a loading on for that as well.
And just one more, what happens if a client has an exclusion placed on their insurance? Is it always there?
So if you have an exclusion, now we've actually seen this a number of times with clients. Back's a very good example. The other one that I've seen quite a lot has been on the mental health stage, and I think we'll see that a bit over the next year or two. Last year was obviously a horrible year for a lot of people and a lot of stress. So people reached out to their local GP, who maybe gave them, a certain number of, kind of go and see the specialist or the psychologist and work through some of your issues. When you get an exclusion, and you might get, say, a mental health exclusion because of that, you can actually get the insurer to revisit that after 2 years. Generally, they like to wait for 2 years. So we've had other clients that have had it's maybe an issue with the heart or challenges like that, and they've actually gone and revisited the doctor and gone through all the tests 2 years later, and we've been able to get that exclusion taken off their insurance, which means now if something happens to them, then they're actually covered. But the insurer just wants to manage their risk, and that's why and most insurers will reconsider and have a look at that time. So no, it's not forever that you have to have it. So yeah. Yeah, so no more other questions?
No, that's all.
Great. Well, thanks everyone for joining. Good to see. I think we had about half the people I know and half all new emails or new people's names. So great. Thanks for coming along. If you've got any questions on insurance, it's one of those things we all, love to hate, I guess, but it's great. When you need it, it's a great outcome, but it's just making sure that balancing between the cover you've got and making sure the policy you've got's a good one, like those ones that you phone up and, get online and all of those. You don't have testing beforehand. So that's going to be a bit of a risk when you go to claim. So take a look at your insurance, make sure you've got enough cover to help your family if something comes up. And if we can be of any of assistance, feel free to reach out, give us a call, and we can help you out. Thanks very much.
Thank you.
Thank you.